While most investors are distracted elsewhere, one undervalued cryptocurrency infrastructure stock is quietly setting up for a potential re-rating. Analysts see near-term upside from $4 to $6 per share, implying 29% to 112% from today's $3 price. Mining economics are shifting, operational efficiency is improving, and the lowest-cost operators are starting to separate from the pack. Reports from Bloomberg, Yahoo Finance, and MarketWatch hint this opportunity could be noticed before the broader market catches on. Before we jump in, welcome to KMI, delivering sharp data-driven insights on emerging tech and high-potential U.S. market opportunities, designed to help you spot the next big winner. Now, let's dive into the company behind these numbers. Bitfarms Limited, NASDAQ ticker BITF. This isn't just another crypto story. It's a story of numbers, efficiency, and potential upside. With a market cap of roughly $1.71 billion, cash reserves of $144 million, and shares around $3, this company could be significantly underappreciated relative to its operational scale. Today, we'll explore catalysts, financials, and analyst-backed price targets of $4 to $6 in detail. Our mantra as investors is simple: metrics over emotion, probabilities over hype. While others chase Bitcoin swings or headlines, disciplined investors focus on valuation, upcoming catalysts, and balance sheet health. Ignoring a mispriced setup like this could mean missing an asymmetric risk and reward opportunity. Today, we'll look at revenue, margins, cash flow, and scalability, not fear or FOMO. Bitfarms operates in cryptocurrency mining and blockchain infrastructure. Revenue comes primarily from mining Bitcoin and selling it to fund operations and expansion. The company also leverages its data center infrastructure for future high-performance computing initiatives, which opens additional revenue streams beyond Bitcoin. Trailing 12-month revenue is $276 million, and in 2024, annual revenue was $192.9 million, up approximately 32% year over year. Gross margin is 43%. EBITDA margin is 38.6%, and net margin is negative at $128 million, reflecting aggressive expansion and energy investments. What's interesting is that EBITDA margins have steadily improved over the past year despite fluctuations in Bitcoin prices. This demonstrates operational discipline and cost efficiency. Compared to peers like Marathon Digital and Riot platforms, Bitfarms operates at a lower per Bitcoin cost, giving it operational leverage as energy and hardware costs fluctuate. Cost per mined Bitcoin is among the lowest in the sector, and efficiency gains from fleet upgrades and expansion could reduce per-unit costs by $500 to $700, directly boosting EBITDA. For investors, this means every Bitcoin mined contributes significantly more to cash flow than peers facing higher energy or maintenance costs. The balance sheet is solid. Cash stands at $144.5 million, debt at $74.9 million, giving net cash of approximately $69.6 million. This provides flexibility for high-performance computing expansion and mining growth. The company's cash position covers operational expenses for nearly 12 months without additional revenue, providing a clear runway for strategic initiatives. Each additional 1 megawatt of mining capacity can generate $5 to $7 million in annual revenue at a marginal cost of around $1 million, highlighting strong operating leverage and potential upside. With planned expansions, Bitfarms could see capacity increase by 25 to 30% over the next year, translating to roughly $15 to $20 million incremental revenue. Let's talk catalysts. Company-specific catalysts include capacity expansions that could add $20 to $30 million in revenue per quarter, and a pivot into high-performance computing, which could generate an additional $20 to $50 million annually. Strategic partnerships with data center operators accelerate HPC deployment, and efficiency upgrades, reducing per Bitcoin costs by $500 to $700, directly increase EBITDA. If fully realized, these initiatives could add $30 to $50 million in annual EBITDA over the next 12 to 18 months. Industry and regulatory catalysts also matter. Institutional adoption of cryptocurrency continues to rise, with companies seeking secure, low-cost miners. Regulatory incentives for sustainable mining, including tax credits for renewable energy use, could further improve margins. Financially, margin expansion from $500 lower per Bitcoin costs could add $10 to $15 million to EBITDA, while revenue inflection from HPC deployment could add $20 to $50 million. Cash flow break-even is expected in the next 2 to 3 quarters if efficiency gains hold. Analysts covering this stock expect a range of near-term outcomes. Conservative target, $4, roughly plus 29% upside. Base case, $4.50, about 58% upside. Bullish, $6, which is plus 112% potential from today's price. These targets are grounded in revenue scaling, margin improvement, and execution of the HPC expansion. Bloomberg, Yahoo Finance, and MarketWatch analysts all highlight the strong probability of operational leverage translating into near-term stock performance. Looking at valuation, the market cap is $1.71 billion, with revenue at $276 million, giving an EV revenue multiple of roughly 6.2 times. EBITDA stands at $106.6 million, implying EV/EBITDA around 16 times. Compared to peers like Marathon Digital at 18 times and Riot Platforms at 20 times. This stock trades at a discount given its operational efficiency and growth potential. Operating leverage is significant. Every $10 million incremental revenue could translate into $3 to $4 million EBITDA, creating asymmetric upside. Of course, risks exist. Execution delays in mining or HPC expansions, regulatory changes, Bitcoin price volatility, and energy cost fluctuations could all impact performance. However, the probability of upside is strong if the company delivers on planned catalysts and maintains low-cost operations. This stock quietly trades under the radar. Smart money investors and analysts are positioning for a re-rating, similar to the path Marathon and Riot took before broader institutional adoption. Strong financials, operational optionality, and clear catalysts create a classic asymmetric risk and reward setup for disciplined investors. To recap, revenue is $276 million, EBITDA $106 million, and cash on hand $144 million. Key catalysts include capacity expansions, the HPC pivot, and efficiency upgrades. The story is about financial strength, operational optionality, and actionable catalysts. If you found this deep dive useful, hit like, subscribe, and drop your thoughts in the comments. See you in the next one.